So, over the past few years, a group of stocks have essentially dominated headlines. And for clear reasons, of course. They are some of the biggest, baddest, most profitable, and the highest growth companies out there in the entire US market. And of course, if you have clicked onto this video, you probably already know what we're going to talk about today. So it's this group of stocks called the Magnificent Seven. So today, I'm very happy to actually bring on board both Bianca and Ping Chin, where they are part of the financial analyst team at Piranha Profits. So maybe before we even deep dive into this group of stocks and to really understand how they did in their latest quarter, I'll just get them to share a quick fun fact about themselves. So Ping Chin, maybe you want to kickstart, introduce yourself to the PP audience and maybe a fun fact about yourself.
Yeah, hi, I'm Peng Chin. Fun fact about myself, I took economics and econometrics in my university, not finance.
How do you pivot from econs to finance?
Actually, I started off in a bank, and
Okay.
after that, because I was into the risk management so-called, and all the models, data, that kind. But in the
Mm.
end, I was like, oh, I still like stock. I prefer stock investing more.
Okay, thanks, Peng Chin. How about Bianca? Fun fact about yourself.
I actually came from a biology background during my university days. How I happened to stumble upon Adam was actually during my university years. I was actually doing an internship back in Malaysia, and he was having a physical webinar. Sorry, not webinar, seminar. And then I just happened to attend it after the work hours. And that's how I got introduced to the world of investing. And from there, pivot.
So to kickstart the discussion on the Mag 7, I think I've actually pulled out 6 out of the 7 names in terms of their price action over the last 1 month or so. So why 6 out of the 7? Because Nvidia is set to report their earnings in the upcoming week. But that said, I think just focus on this 6 alone. You can see that it's split up into very distinct categories. So you have 3 out of the 6 actually performing quite well over the last 1 month. And you can see that there is a very significant spike. And some of you might naturally be asking the question, what happened to them? Why did they experience such a huge rally in such a short period of time? And most likely than not, investors were voting with their dollar bills, thinking that after their recent earnings, they actually deserve a much higher premium. So, of course, we have Google leading the pack, and Apple and Amazon also sitting at a comfortable increase. And then you have the second category of stocks that are probably much more lukewarm. I think I'll consider Microsoft in there, even though, yes, it didn't perform as well as the top 3, but not too bad either. And of course, the third category, we have Meta. So Meta has experienced a very significant bloodbath. It's down 15% on a 1 month basis. With Bianca and Ping Chin joining the call today, they've actually deep dive and to really run through the numbers, and they can give us a better perspective on what happened to individual companies as well. So our objective today, very simple. You're gonna sit down with us for the next 30 to 45 minutes, and we'll make sure that you have a much clearer view into understanding this group of tech stocks. So maybe to just kickstart the entire discussion, just some general comments after looking at all these tech companies' report. Maybe Bianca, you want to share what's your general view of them today?
Yeah, sure, CK. So I would say overall, the Magnificent Six or Seven, if we want to just rope in NVIDIA into the picture, they essentially sit in a small group of companies where AI disruption is clearly visible. So there has been some talks about, especially that Adam covered in one of the previous videos, where there's this recent Gen AI divide report produced by MIT that was suggesting that while AI adoption is actually really high, well, Gen AI specifically, there's only a couple of sectors, well, mainly tech and the media sectors, that are showing a clear structural change. And as how Magnificent Seven essentially covers the tech sector, they are part of the small group of companies that are already showing tangible benefits from the Gen AI quote unquote revolution. So, okay, when I say that AI is no longer just a story or like a vision, I am really talking about these big tech names specifically, because AI is actually showing up as real, well, top line as well as real productivity gains. So we can see that based on the recent Q3 earnings reports, like for the big names such as Microsoft, Amazon, and Google, they're already seeing customers actually paying for AI services in the cloud. And they're also using AI internally to boost their employee productivity. So if I'm going to quote like Google specifically, so the CEO himself, at least half of the new software code that was produced by Google is actually written using AI. So the same teams can actually deliver more in less time. So this is actually just showing one of the core examples that how AI is essentially being like taking over the big tech industry by storm. And of course, we also need to look into the part where how all these big Magnificent Seven companies are also spending tens of billions into capital expenditure surrounding AI. So whether that is a long-term investment into the data center infrastructure as well as AI chip technology. So essentially what this brings me to say is that these Magnificent Seven companies are essentially building a strong and long-lasting infrastructure or in turn economic moat for their companies. So this in turn actually can build upon into a strong barrier to entry in the long term. And therefore, from an investor's perspective, or at least personally, I would say so, I think it's just a BAU or business as usual in the sense that I personally just stay invested in the Magnificent Seven in the long term based on the current progress. And personally, I'm not too worried about the price action because I'm essentially still thinking for the long term. So that's my general comments.
Right. So in fact, before I actually come to this sharing, I've actually looked through some of the earnings report that we prepared internally. So this is what we do for our subscribers at Ultimate Investors Playbook. And I thought that I just really wanted to kind of have a feel in terms of what we've done and what we've compiled over the last 2 weeks or so. So maybe from there, I just wanted to ask Bianca, were there anything in particular that surprised you specifically for this set of companies' earnings?
So I think actually one of the biggest surprise is how fast the sentiment on Google flipped in the sense that because at one point, especially when Gen AI, ChatGPT and the likes just blew up across the whole world, a lot of people were actually being very bearish on Google and thinking like, okay, Gen AI is going to like destroy Google, they're gone, and therefore have a huge sell down. I hold the personal opinion is that they are one of the key AI leaders in the whole big tech industry. And I guess this whole reversal tells me two things. So number one, Google search is far more resilient than what people feared. And then second of all, Google actually has a really strong AI executional ability, especially with their Gemini and their set of AI tools, as well as their own AI chips. So that's why it kind of boils back to my point earlier about thinking long term and not being swayed by these short-term news or scary sounding headlines. And Google is one of the big examples about, I guess, things that surprise me personally.
Peng Chin, how about yourself? Anything in particular when preparing the reports or looking at some of these names? What were your biggest surprises?
Actually, I think my similar thought is like the sentiments on Google because I think in April this year, people are pretty pessimistic of Google future prospect. And then suddenly now they are calling Google as the leader of the AI. So it is a huge surprise to me. But the second thing is also, I think we can see a two clear path that Magnificent Sevens are taking on their own. Like, and the first one, I think is clearer in a sense, is that Google, Microsoft, and Amazon, they are kind of like a infrastructure owner. They build the infrastructure, the cloud. And so we can see this is a pretty profitable future prospect that we can be almost certain on. So I think it reflects in the price actions also if you look at the three infrastructure. But for the other side, I would like to group Meta and Tesla maybe in the same group, is that people are generally more concerned or not sure, uncertain of their future because like Meta and Tesla both are into the physical AI side, so-called. With Meta is the augmented reality thing, the Ray-Ban, and the Tesla is they've been mentioning for years, the FSD. Yeah. And so this is uncertain, but I think if they succeed in the end, the future is bright for them as well. Actually, physical AI side is a huge upside, but the only assumption is they can succeed. So I think there's a very two clear different path that Max Sevens are taking. Oh, sorry, I didn't mention Apple.
Because they're
Boring in
not
a
doing
sense.
AI.
I don't know what they're doing,
I I
but
I look at my Siri, right? I'm quite disappointed because my friend recently bought a Pixel phone. So, they also do their phone, right? And in
yeah.
terms of the capabilities on a Google Pixel, I think I'm quite bullish in terms of where Google is going, but I really don't know what Apple's doing.
I think that's a surprise, man. Like for this earning call, I try to focus on what the CEO is gonna say, and I was like, "Oh, where's your AI?" Yeah, they've been saying it for multiple earning calls that they are into this AI race, but well, for now, I didn't see a real actions lah on their side, so maybe there's a surprise also.
If you're enjoying this conversation, go ahead and give the like button a gentle poke. Can you also outline for me in terms of Apple's, because you talk about their business strategy, which is not too much about AI, right? Which also means that their spending is not as crazy as so-called your hyperscalers and even Meta and Tesla as well. So can you outline like what's the current, how does the capex look like? And are you concerned? Because I'm seeing a lot of headlines around saying, oh, they're spending $300-400 billion run rate in the upcoming 12 months and considerably or notably larger in 2026. How are y'all looking at the current spending plan?
I think we can start with Apple. Apple, I think they're adopting a pretty different approach compared to other Magnificent Sevens. And well, it can be wise or it can be foolish. We can really judge it like for maybe another 10 years, right? But I think Apple is trying to not to invest tons of money into CapEx, so-called, but they turn it into OpEx. So that means it's not a one-off capital expenditure, but they will focus more on the AI expertise maybe, and to turn it into the annual user expenses. If you look at other Magnificent Seven, right, especially the three hyperscalers, or even four if you consider Meta, they are putting tons of money into building the infrastructure, especially the data center. For Meta is the Ray-Ban, the physical AI side. So they are burning a lot of money. But I would like to quote the CEO of Meta, Mark, when he said that in this AI race, we rather to overspend rather than underspend. Because imagine you are in a real competition, and if you overspend, what is the worst result that can come? It is you spend more money, but they are the money printing machine. So every quarter they are backed by a very strong earning power. So I see no concern at all. The worst thing is they waste money. But what is the cost of losing the competition? Like what Mark said, it is they are losing their economic mode in the long run. And I think there's a huge cost that no companies, especially for them, they don't want to risk the possibility of losing the game. Even for Meta, right? You see the real increase in productivity. Like Mark keeps saying in the earning call, the AI is keep enhancing the so-called engagement, and that turns their advertising machine into a more efficient and more profitable machine. And we do see a real result from the capex. So in the long run, I'm bullish on it. And maybe in the short run, you can argue they are spending too much. I think I'm side with Mark on this. Like I rather them to overspend to not underspend. Yeah.
Also, just to share one stats, right? I believe you guys are aware Reels is their answer to TikTok not too long ago. I think it was 3-4 years ago. So want to take a guess. I'm not too sure you guys have came across this during the earnings call. What's the annual run rate of Meta Reels today in 2025? It became a $0 business to currently they're doing roughly $50 billion on an annual run rate basis. They came out with a so-called new business model and then boom, they started printing $50 billion a year. So that's generally how you look at when they structure the businesses. A lot of people are betting on the future growth opportunity.
Actually, essentially, I just wanted to build upon Benjamin's point, and I guess actually your point as well that as much as how the total cost at an expense relating to building their whole AI infrastructure for Meta specifically has definitely climbed in a double-digit growth rate. A lot of it is actually, at the end of the day, boiling down to having the AI infrastructure built out and also actually hiring the right talent. Yeah, as Meta, if I'm not mistaken, they even hired one of the key AI leaders, Alexander Wang, who built Scale.ai into the business so that they can essentially enhance their long-term economic mode. And despite all of this, with how both of you gave some examples, Meta's operating cash flow, if I'm not mistaken, hit about 30 billion US dollars, and their free cash flow is roughly about 10 or 11 billion US dollars. So I'm still not worried about Meta's current situation because they still have a strong cash conversion and ample self-funding capacity. So the point I'm trying to bring across is that their business fundamentals now, with their current business models, on top of building their future economic mode, is still pretty strong.
Then can I just probe a little bit further? So now let's assume that They're still healthy in terms of free cash flow. What if comes a quarter, maybe the next 3 to 4 quarters, you start to see Meta printing negative free cash flow? So would that start to be a concern for you? Or what are the specific things that you look out for?
I think at the end of the day, personally, when it comes to quarter report, I will always take this as more of a short-term symptoms of the business. And I think ultimately, I always do boil it down to think long-term. And of course, consider during the earnings call, let's just say if there's suddenly a negative free cash flow or even negative income, can the management essentially explain what was going on, usually in their earnings call? Sometimes it could just be what they call in accounting, an accounting loss that I've seen in other businesses. So it's very contextual driven, and I can't comment on, okay, if the moment I see a negative income, then immediately sell. It doesn't make sense. So it's really contextual driven.
Actually, on this point, right, I just wanted to ask, maybe either of you can take on this question. So what happened? Why did Meta tank like close to 13-15% after their earnings? Considering that we talked about them driving their main business and we see increased amount of growth. Yes, they want to spend a lot more money. Why are investors getting jittery in a general broad sense?
Yeah, I think for Meta, right, as I mentioned before, I think they tank for two reasons. One is, yeah, even AI enhance the productivity now, but we also have to acknowledge, right, on the physical AI side, for now, it looks like an uncertain black box because we don't know what the future will look like. And Mark is super bullish on it. He threw tons of money into it and calling it the future and saying phone will be replaced by Ray-Ban in future. And well, investor, I think they are uncertain on it. So when so-called you construct a model, maybe a DCF model, they will give a higher discount rate. They will just assume a lower growth rate. And so it will result in a lower intrinsic value. And the second thing is, I think the concern of market is the growth of CapEx. I think it's the first time or one of the few times that actually it outpaced the revenue growth. So in the past, even the capex will also accelerate, but it's not outpacing the revenue growth. And I think market in the end, they like a certain fact. They don't like an uncertain future. And so the better you can present your profitable path, the three hyperscalers, the market will give you a higher premium. And one of the pretty good example is Google. In April, actually, all of us know Google was undervalued that time. But people are just uncertain on the search engine. They don't know where will Google head to. So the PE, if I remember correctly, well, Microsoft and Apple is trading at 30, 40 multiples, right? So in the end, I think market just don't like uncertainties. And this is the same story happening to Meta right now.
So did you buy Google when during the PE was 17, 18 back then?
Actually, I do. I I overbought to a certain extent.
Okay.
Yeah, because I have a rule. It's like I don't want any single stock to exceed 10% threshold in my portfolio. But for Google that time, I was like, it doesn't make sense at all. Like, how can Google trade at 140 when I know it's a 300 stock? I'm just an example. Just
Mm.
an example. Yeah. So I overbought so-called. Yeah, but I think it's worth it because everyone knows it's just a sentiment. And when the sentiment shifts, the price will catch up to the intrinsic value.
Investors are constantly focused on any hints of any of a slowing growth in the future, or whether it's revenue or bookings or billings. And sometimes if companies they have even a slight hint of a revenue slowdown whatsoever, basically something in the future may not be up to par with the analyst expectations, then the market will essentially punish it. Or in this case, everyone will start selling off or putting a sell rating.
So maybe also now, since we've talked quite extensively about Meta and Google, right? How about moving to the three hyperscalers that you all talked about, which is Amazon, Microsoft, and Google. So can you all give me some understanding of color? I know, give or take, some headline news about AWS reaccelerating again. Microsoft signed pretty much a lot of deals around and OpenAI boosting its growth and things like that. So help me understand a little bit more on what we should know about these three more so-called infrastructure play. How do we look at them today?
Maybe I can take on Amazon and Google. For Amazon, right? I think, yeah, as the headline shows, the cloud growth reaccelerates, and this is a pretty good sign. And the second thing is, same as Google, I think what's interesting about them is they actually have their own chip. For Amazon and for Google, which is TPU in Google examples, is that they try to develop their own chips rather than just relying solely on NVIDIA chips. And well, even for now, I don't think they are at the same par with NVIDIA chips. But in the long run, actually, I think it's worth it for two reasons. For one reason is I don't want to go into chip industry that much, but just briefly is that when NVIDIA is trying to build a chip that can be used for general purposes, right? For everything, even for the car or the hyperscalers into their data centers. But when Amazon and Google try to develop their own chips, right, they can build a chip specialized to the task that they want it to be. So it can actually run more efficiently in the long run if they can successfully build a chip that can tailor to their needs, maybe for the AI models. For now, very popular trend is they're trying to develop chip that can be tailored to the so-called inference side. So that's a pretty good sign. And the second thing is, it's not good to rely on a single supplier in the long run because it's like in a business, you only have one supplier. And what if the supplier don't want to make friends with you anymore? And basically you die, right? So when I try to have this kind of vertical integration, so I would view it as a pretty good sign they can be independent of other suppliers. But like even for now, there's often a shortage of the chip supply. And yeah, I think it's a good sign they want to build their own chips.
So when we look at these three companies, I presume, including Meta, of course, as well, they are basically the biggest customers of NVIDIA. And based on their guidance, right, does it hint to us anything about whether NVIDIA's earnings growth still continue on and things like that? Are you able to see anything from there? Or to turn around the question, to make it simpler, is NVIDIA still an attractive stock today, especially because of the guidance provided by some of these hyperscalers and their continuous spending? Because I would presume that it will naturally flow into NVIDIA's earnings as well. Because as they step up their spending, NVIDIA will step up their growth. Is that how we can read it this way?
Yeah, I think so. Because even we talk about chips just now, right? It's not a immediate result that we will see. They won't buy NVIDIA chips anymore. It's not the case. Because like when we listen into the earning calls, actually all the CEOs they are basically just delivering a same message. They said we are running out of chips and we need more chips and we want to have more money to buy the infrastructure, to buy the chips to build our data center. So definitely, I think NVIDIA will have a amazing quarter again. But for the next few quarters, yeah, I think NVIDIA will still have a pretty decent quarters.
Now, I think the last company that we haven't really talked about much, which is Tesla. So Tesla in this case, I think it has been one of the most volatile runners. I just pulled out the chart, right? It's just up, down, up, down, up, down. It has been like that for the good last 5 years. So I just wanted to get your view on how do I look at this company today? So you said that they're not a hyperscaler. They do buy quite a bit of NVIDIA chips, but that's for another part of Elon's business. They have a car business. They're talking about full self-driving. They are potentially looking out into robotics and things like that. So how do I understand this business today? If let's say I'm a prospective investor.
Personally, I'm a believer of Tesla. Yeah, so I think in future, it's just a matter of time. They will actualize the FSD future. I no doubt on that. And even though I say that, I think it is not as simple as what Elon Musk has been telling us, right? Once the FSD technology is mature and suddenly they will become the monopoly in the industry. I don't think so. Yeah, I would like to think maybe it's multiple giant players. They are competing in the same industry. And for now, we can see way more, right? Or even Uber in America, I think, in the North America. But I do think Tesla has a pretty unique strength in terms of their fundamental technology because I guess I won't dive deep into it, but for FSD, there's a very unique strength is that they can scale up very quickly. For Google, for Waymo, they need to map out the whole cities before they can run their Waymo business in it. But for Tesla, imagine as humans who is driving the car, he can learn and he can adapt to different conditions. And it gives you a very unique strength is that if Tesla FSD can run in America, then highly likely it can run in let's say UK or Europe. Singapore, I don't know, but maybe not Malaysia. Malaysia has a very messy road. Yeah, but yeah, that's a unique strength. That can scale up very quickly. So actually, I'm bullish on Tesla long term. But for now, the valuation doesn't make sense because for valuation, we look at the result we have now, the numbers we have, and Tesla is clearly overvalued. If you count in the hope value, I so call the hope that we have, that we can have a full FSD future, then I think the upside is very bright and huge as well for Tesla. So yeah, that's my take.
How do you do that? So I wouldn't use hope, but more about like when you envision into the future. I think that's a nicer term. So when you envision out into the next so-called decade or two, how do you calculate how much is FSD worth, how much is robotics worth? Just wanted to hear your personal take on this.
Actually, I think most people misunderstood what Tesla really is because Tesla actually has a hidden industry. They call it the energy part. Actually, there's a pretty bright industries that, especially in this AI era, that I think we all know that energy is an essential part to run all the data center, right? And Tesla, well, is not in the nuclear energy side, but they are into the industry that help us to store the energy. So if you look at the growth rate, actually they are growing at a double-digit growth for every quarter for that part of Tesla. And when I do the sum of the part approach, actually I adopted a pretty conservative view towards the FSD. I didn't even take into account the humanoid robot because I think that's too far. That is just a future that Elon Musk is trying to tell us. Yeah, but just on the energy side, I think the value is easily 200 per share. So together with other things, right? The hope value of the FSD and also the current existing car business, which I don't like because I think car business is a pretty bad business, very thin margin and very competitive. But based on the previous two, which is the FSD, I think it's pretty close now. Because I do watch a lot of videos about their development of the FSD and also the energy business. I think at most, I think the IV is around 200 to 300, that range. Yeah, so I think now is overvalued. It's not too far-fetched as some people would describe.
Okay, thanks Peng Chin for sharing. So I think it's quite clear that Peng Chin is relatively bullish on Tesla. And he's quite excited about the company. Just wanted to ask Bianca, is there a company in the Max 7 that you express equal excitement for?
I would say Peng Jin's level when it comes to his enthusiasm for a particular stock, in this case Tesla, is usually through the roof. I tend to adopt a more grounded stance of like, okay, as long as the business fundamentals are good, it passes the investment criteria steps that Adam has shared in his Ultimate Investors Playbook or investing courses, I'm happy I'll invest and put my money into the company. So in this case, well, mild disclaimer, I personally did not invest in Tesla, but I did invest in the other Magnificent Six stocks. And altogether, because it just passes the investing criteria, which involves whether it's a healthy business and whether it has a good long-term potential to still last in the next like 5, 10, 20 years. And also, well, at the point of time upon buying, is their share price below their intrinsic value, well, at the point of buying for myself.
So there is no particular overweight here in the 6 names?
You mean like I put a lot more money
Yeah.
into a specific company? Actually,
Yes.
no. Because as how Peng Chin shared about allocating wisely, right? Actually, as an investor, as much as how you love a stock very, very much, there is always a risk of, something one day, miss earnings expectations or a guidance that was slightly weakened, as how we discussed earlier. Your share price could just suddenly just go down. And as an investor, you have to kind of separate your investment acumen or investment style from how you feel about a certain business or certain CEO. So at the end of the day, you still need to allocate your money equally to these different stocks, so that I guess in the long term cushions any risk of sudden volatility, especially when it goes down. If for whatever reason one day Google share price goes down again because of how Gen AI has shook Google's share earlier this year.
Actually, I also wanted to ask, presumably, assuming that let's say you entered the positions on a equal weighted basis for the 6 names, right? Presumably as well, because the performance have dragged out by quite a bit. Do you do rebalancing or do you just let them ride it out?
Actually, that's a good question. To some degree, I have a bit of a debate on this, and I'm still trying to find an answer to it. Like, For the time being, I would say that I have not arrived at a situation because my allocation are still fairly equal. But actually, admittedly, I'm not too sure about what I'll do with them yet. If one suddenly there's a one heavy weightage, I think there's a high chance I'll still probably leave it as it is because my share allocation grew organically.
Maybe one last point on this Max 7 discussion. We talk a lot about like their earnings, what to look out for. I think one important thing that we cannot shy away from is clearly the valuation or the stock price itself. So are you all able to give me a screenshot view of what's your view about the Max 6 names today in terms of valuations?
I think for valuation, right? I know some people would call it a AI bubble because of their spending, but I don't think it's a bubble at all. But I don't think it's cheap. Many of the names, I think they are at fair value. For example, right, for Microsoft and Apple, I will talk about Apple later, but for Microsoft at least, I think it's traded at a fair to overpriced, slightly overpriced. Investor pay a higher multiple of earnings to Microsoft if you compare to even Google now. The PE is at the high side. But I think Microsoft deserve it because their AI monetization story is pretty clear, as I keep mentioning just now. And I think the cheapest one would be Meta now, right? Meta look cheap, but again, the physical AI side is uncertain, so maybe investors are more worried of that. And Amazon is at fair value, but just 2 weeks ago, I did buy a lot of Amazon because I think at that time people are generally more bearish on Amazon and saying they are lag behind in these areas. But once the earning come out, they re-accelerate and yeah, suddenly the price catch up. So I think now Amazon is at the fair price. I think my biggest valuation concern is actually Apple. Even though Apple, we didn't see explosive growth in price, right? But remember, like when we talk about undervalue, overvalue, we often have the intrinsic value in mind. For Apple, yeah, for multiple years, it traded at a premium multiple, but the growth is not premium. And the upside, the AI upside is still unclear for now. Apple has been traded at premium valuation is because they have a very wide economic mode, which is their ecosystem. So, but for now, I still hold my view. I don't think the AI story is clear at all. I don't see any clear actions for them to win this AI race. So for Magnificent Seven, actually, I hold 6 of them, except Apple. And Tesla, as I mentioned just now, is high risk. But personally, I see the AI story is clearer than Apple. So, but definitely, I don't think Tesla is cheap at 400. Maybe it's cheap at 200, but definitely not now. Yeah.
Bianca, your thoughts on current valuations?
I would say the one that really stood out to me was essentially like Meta's valuation taking a hit at the moment because of the uncertainty surrounding its physical assets, so Ray-Ban and their metaverse thesis. But at the end of the day, when it comes to the other Magnificent Seven companies, I mean, a bit like contrary to Peng Jin, I do think that they have all expressed a certain degree of conviction into showing their capital expenditure into AI. It's just that, yeah, relatively speaking, Apple, as how Peng Jin mentioned, has a bit of an unclear narrative as opposed to the other Magnificent Seven stocks where they are building either like their data center infrastructure or their AI chips, well, relatively self-sufficient AI chips capacity. I would just say my stance is just more any companies that are showing a certain degree of uncertainty in terms of how their high capital expenditure is able to justify the future growth story surrounding AI, they may take a bit of a punishment from the stock market. But essentially, I'm not too worried about it because these are more of like short-term speculations.
Just a bullish thesis on Apple, which I think is reasonable, is that even though Apple is quite conservative now, but Apple in the end, they control the end users, right? Because they have a lot of iOS users. And this is a unique strength of Apple, we have to admit that. In the end, no matter how advanced your models is, like no matter it's ChatGPT or Gemini or Anthropic, they're still trying to get their models into iPhone, into your Mac, because they want to get access to the billions of iOS users. So I think Apple still have a pretty unique strength, even in these areas, because they have contact with the end users. Yeah, so just that maybe now they are not doing a major things in terms of their AI development, but yeah, we shouldn't underestimate the capability of Apple. In 10 years down the road, if Apple win the areas in the end, we shouldn't be surprised at all. Yeah.
Actually, I just have a quick side nosy question, right? I just wanted to ask, it came to me just now. If you guys don't mind sharing in terms of percentage exposure to these 7 names in your portfolio, you mind divulging it, like in terms of allocation wise?
I can.
What's your exposure to these 6 names, for example?
Let me open my stock
Sure.
oracle. I think for Max 6, right?
Mm,
My Google is 16.3%. I'm just talking about the single stock. I know just now
yeah,
I said it shouldn't exceed the 10% rule, but again, I exceeded when it's
right.
cheap. And for Tesla, it is 13.9%. But actually, I didn't break my rule for this because it just grow organically. I bought it at 170 and it doubles. And for Nvidia, it is 10.8%, and Meta is 10.2%. Amazon is 9.2%. Yeah, and I didn't have Microsoft and Apple for now. Actually, I do have Microsoft back then, but after that, because I have little concern of their valuation, so I sold it off about last month.
Okay, so if I add it,
Yeah.
a very quick math, right? It's roughly 60% of your portfolio in the Max 6 names. Okay, maybe last point from me, right? I think one of the concern that we shared just now about this idea of an AI bubble, and I'm not too sure you all came across the Financial Times drawings about the whole circular argument about how OpenAI, Nvidia, and then AMD and Oracle, that whole infographic thing. Maybe Bianca, can you share a little bit more on? Are you concerned about this circular financing arrangement as well, and what's your thoughts on them thus far?
I think for the context, it's like, if I'm not mistaken, the secure financing was relating to Nvidia investing in OpenAI, and then OpenAI spending a lot on Nvidia's chips, and then some of the workload runs on Oracle's clouds, and Oracle actually buys a fair bit of Nvidia's hardware. So I mean, if you have to kind of join out this whole loop circular financing, personally speaking, I'm not worried about it, or like I have close to zero concerns, because I think ultimately a lot of the worry surrounds upon the whether this is a bit of a Ponzi scheme. But I always take it as, at the end of the day, as long as the products or services generate real value, like actual tangible economic benefits, and how we discussed earlier in this discussion, AI is clearly improving their advertising, the speed of coding, and actually automating real business tasks. In other words, they're actually products and services that these three companies are offering to each other are actually producing real benefits, whether it's to their top line and bottom line, as well as their productivity. It's not something that I'm going to worry about and then therefore lose sleep at night.
In the end, the circular financing is just how economics work. It's just like how our money work in the real world, right? I give you 1 ringgit, you give Bianca 1 ringgit, Bianca give me 1 ringgit, and this is circular financing. When each transaction happens, as long as there are real goods and services being transferred, and in the end, this triangle that can create a very much value compared to what we have initially, right? Maybe it create more employment opportunities, or it can raise up the GDP in the end. Like what Bianca said just now, as long as it has a tangible output, the circular financing is not a concern at all. Because in the end, if you really think about it, it's just how money works, how economics work.
So I think this discussion around the entire AI financing is a good note for us to end off. And if you guys have any questions, you enjoyed this discussion with our financial analysts, feel free to leave in the comments, and please encouraging notes as well. And we'll see you guys in the next video. If you have stayed till the very end, I'm sure you love investing and trading as much as we do. And to get more market insights from the team, you can sign up for our weekly newsletter, Investing Bites, where we share short, real-world examples that help you build a better investing framework. So the link to sign up is in the description below, and we'll send the latest issue straight to your inbox. If not, I'll see you in the next video, and this is CK from Piranha Profits signing off. Till next time,